Good afternoon and welcome to today's webinar. I'm just going to allow a moment for people to join. We have people joining rapidly, so I might just get started and we'll let everybody join. So yeah, welcome to today's webinar. My name is Jason Kennewell. I'm an investment director here at VentureCrowd. For those of you that don't know, VentureCrowd is a digital investment platform for private market assets, specializing in venture capital, real estate, private markets, and managed funds, or private credit and managed funds, excuse me. We have over 4,500 investors and over 80,000 registered members, and have invested over $440 million through the platform since inception into hundreds of different projects across all of the asset classes in which we specialise. Today we'll be discussing the Sydney Angels Sidecar Fund number 3. It's one of Australia's most compelling early stage venture capital opportunities, which will be delivered by VentureCrowd CEO Steve Maarbani. As you may already know, Steve is a corporate lawyer and former PwC partner specialising in funds management, and is responsible for the legal, compliance and asset management aspects of VentureCrowd's fund investments. And we also have Sydney Angels Investment Committee member Adrian Bunter. Adrian is also an experienced angel investor, professional advisor and non-executive director with over 30 years experience. He is also a partner of Modus Partners Australia, a boutique specialist corporate advisory firm. We will give everybody the opportunity to ask questions during the presentation, so please submit them via the Q&A button at the bottom, and then we'll leave time at the end of the webinar for those questions. We're also recording today's session, so if you do need to jump off early and you'd like to send this to someone who might be interested in the fund, a recording will be sent to you as well. So with that, I'll hand over to Steve to get started.
Thanks, Jace, and thank you everybody for joining us. This fund has been extremely popular. Tranche 1 reached its target investment amount in only 3 hours and was oversubscribed by 350% in its first week. Since then, the fund's gone on to commence its investment program and has made some exceptional investments that are already part of its portfolio. And we'll talk about that in just a moment with the one and only Adrian Bunter. Adrian and I are old mates since our PwC days, and there really are very few people in the country that understand this space as well as he does, and have both the battle scars and the incredible exits to prove it. Before we get to Adrian though, I just want to share some quick context around something that happened just last month. Last month, a private Australian health tech company founded in Sydney just 7 years ago was acquired by a New York listed healthcare giant for $1.6 billion. That company was Eucalyptus. Eucalyptus is a digital healthcare company that builds direct-to-consumer telehealth brands. And through a very nuanced strategy around consumer needs that weren't being met, it's gone on to grow rapidly since it started. And of course, about a month ago, as I mentioned, it was acquired for $1.6 billion. There was no ticker code, there was no analyst coverage, it wasn't included in any index. It was just a lot of hard work by a group of resilient founders and a team that went on to build significant value for shareholders in just 7 years. None of that was created on the ASX. None of it happened inside an ETF. In fact, it happened nowhere near the public markets. It happened entirely in the private markets. And that is the most important, thing about this story. This is not an isolated example. This is definitely a pattern. As more and more companies choose to stay private, some of the world's best companies, the most high growth companies, just cannot be accessed on the public markets. Jace, we might just move to the public market graph. One more, please. There, thank you. No, just go back. Yeah, there, thank you. So in fact, according to JP Morgan, the public markets, the listed markets are declining at the fastest rate in 25 years, and they are forecast to continue to decline. And so the public markets today simply don't provide diversified exposure to the true universe of corporate stocks. According to Apollo Global Management, 81% of companies with revenue over $100 million are private. Even the indexes are now heavily dependent on a few companies for their performance. Meanwhile, private markets have grown spectacularly over the last 2 decades, and they're forecast to reach 21 trillion by 2030. The bottom line here is this: when you compare the data between side by side, what becomes very clear is that the investment markets are undergoing a massive global shift from public to private assets. And so, if investors want diversified exposure to the true universe of corporate stocks and where the next decade of returns are being built, they have to have a private market strategy. Now, the good news is we live in a country where there are more unicorns built per dollar of capital invested than anywhere else in the world. And as the Australian innovation ecosystem continues to get even stronger, that growth rate and the success rate of private companies in this country is only likely to increase. It's also the case that the Australian venture capital and private equity consistently outperforms public markets over the medium and longer term, according to analysis by Cambridge Associates. The next decade, the next generation of high growth companies in AI, in health tech, in climate, in defense, in advanced manufacturing are all being built right now, and they are being built privately. So the only question really for investors is, how will you get access to curated quality venture capital investments? How do you position yourself to have the right exposure to where the next decades of returns are being built right now? And that's exactly why Sydney Angels Sidecar Fund was established, to give as many people as possible the opportunity to have passive exposure to a curated portfolio of quality companies for a relatively low minimum investment amount. And I'm thrilled to say that the market has received this fund very, very well so far, with the first 5 million now closed in record time and the final tranche now open. So let's get under the hood of the fund. Adrian, welcome.
Thanks, Steve.
Why don't we start with the one question that we get asked over and over again, which is, why is it so complicated? How does it work? How does screening through to exit work? And I know there's a lot in here, but do you want to give us your summary of the angel investment process, the private company investment process, from screening through to the end?
Yeah, sure. And you're right. There's a lot on this slide, and this is in the prospectus. I am for people to sort of get into it in detail, but at a high level, if you think about, there's sort of 4 core buckets of things that need to be done, which is that initial screening of the opportunity as it comes through. Then you move through to actually doing that deal selection and due diligence, and actually working through and actually making the investment decision, which then forms into the syndication, negotiation, and investment, actual investment. A lot of people think that's where the work finishes, but then you've actually got the period that happens after that, which can be 3, 4, 5, and up to 10 years after that, where you're actually managing the investment and actually working towards monetizing and actually liquidating that company via an exit transaction, and actually making your returns. So that screening process, Sydney Angels runs 6 screening cycles a year, takes applications throughout the year. They generally receive 30 to 60 applications in that process, and the committee and a handful of members will rank those companies to things that they think are interesting and good potential angel opportunity deals. At the end of that cycle of screening, we get to what we think is the top 6 companies. Those top 6 companies come and pitch to a deal screening meeting, which is made up of about 15 angel investors. It's a good slide. Yeah, so 15 angel investors on the deal screening meeting. They then rank those companies 1 through to 6 around that. And the top 3 of those companies then go through to a full members meeting. They then do a 10-minute pitch, 10-minute Q&A, have a conversation about it. The members then say, yes, I'm actually interested in learning more about that particular company. And anywhere between, sometimes all 3 companies, but 2 to 3 of those companies normally have syndicates form around them, who then go away and do due diligence. And one of the differences between Sydney Angels and general angel investing is this team-based due diligence and investment process. I've got an expertise in a particular area. I'm not a tech person. I'm not a marketing person, but I have other members in the group who are tech people, who are marketing people, and we work together to actually do that due diligence and understand the business, and actually things that I think are fantastic, other people point out the flaws around that. So it's a very, very robust process where multiple minds ultimately make a better decision and filter out the things that on the face of them look really, really good. And then that team individually makes their own investment decision, puts their money where their mouth is, and then ultimately comes through to the sidecar fund for co-investment around that. Now, the important thing about that team doesn't just stop there. Because they're invested, they've also got a vested interest in helping the company grow over that going forward period as well. So that's sort of at a high level what it looks like. There's 92 companies in the portfolio by the end at the end of the year. There's actually a handful more that have come in. This will actually show you the applications that have come through. So we're sort of hitting around 300 applications a year at the moment. You'll see the biggest blocks in each of those years is the blue block, which is the ones that are screened out on application. They don't even get through to the deal screening meeting. And then you'll see sort of the red, yellow and green are the ones that are ultimately getting through to the deal screening meeting. Then half of them go through to the full members meeting, and then a very small smattering of those actually get invested in. I think when I looked just recently, there's been over 3,000 total applications that have come through to Sydney Angels, and just under 100 obviously been invested in that. So it's a very rigorous process that goes through and does it. And here's a selection of what was the 92 as at December, and there's a couple more that have added on post then that sort of completed over the last couple of months on that. So yeah, it's rigorous, it's exciting. Well, happy to dive into any and all of that stuff.
Yeah, let's do that. Let me ask you about diversification in particular. Anybody who's building an investment portfolio knows that diversification is probably the most important aspect, one of the most important pillars of an investment portfolio. In venture capital, though, it's even more important, isn't it?
Yeah.
Do you want to talk us through sort of the kind of numbers around, the number of companies that succeed versus those that don't, versus those that just pay back what was invested, and how you think about that in order to optimize returns in this high risk, high return category?
Yeah, it's interesting. There's been quite a few studies over the years into angel investing in that venture capital space. The most robust ones are out of the US and the US market, but they indicate generally about 50% of companies, you lose money on about 50% of companies around that. And of that, a quarter of them, you lose 100% of your money. You don't get anything back at all. And another quarter, you get something back, but less than what you actually put in. And then it's, 10% of companies do really, really well out of, sort of call it 10 times plus returns. And then the rest of those ones, that sort of the remaining 40% are in the 2 to 5 times kind of returns. And when you blend it all together, you actually get a great outcome as an asset class. The trouble is, when you're starting out in particular, for a lot of people, it takes a lot of time to go through and do the process and actually understand it and do the due diligence and then do the follow-on management of it. But B, especially in the early days, is almost every single startup you see looks fantastic, right? Startup founders tell a really good story. They're really enthusiastic about it. They have to really believe in what they're doing, and that comes across, and you want to believe and you want to actually back them. But chances are, if you only do 3, 4, 5 investments, likelihood is you're going to actually lose money as a result of that because you don't have the diversification. So generally studies say you need to do somewhere between sort of 20 to 30, 25, 35 investments to get a decent diversified portfolio, which does two things. Actually gives you a decent chance of hitting some really, really good outcomes and actually getting some great returns, which is what you need to pay for the ones that actually fail. So yeah, you need 25, 30 investments.
Let's talk about some of the ones that do really, really well. Obviously, we're looking at EasyCollect here.
Yep.
Do you want to tell us your involvement with EasyCollect, just to give people a feel for what's behind the process that leads to some of these headlines? These headlines are absolutely possible. That's why people want to be in venture capital. The risks are there. Diversification is part of that. But do you want us to talk people through your personal journey with EasyCollect, just to give people a feel for what they're paying for, right, when they invest in a fund like this that's managed in this way?
Yeah, so EasyCollect came through Sydney Angels, and probably about 7 or 8 years ago, I think it was. They came through on their very, very first seed round on it, where they'd launched the product, they'd had some small amounts of revenues. It was clear there was something working there. I was originally an accountant by background, so they were like an accounting solution that helped with accounts receivable management. So it was a problem I was actually quite familiar with. So I invested as part of the very first round with a syndicate of about a dozen other Sydney Angels members. In the early days, my first involvement was really just helping them with feedback, some general introductions, giving them some guidance around it. After I think it was about 3 years, they actually asked me to join the board of it because they're sort of going through that growth phase, and wanted probably some more robust board conversations, actually helping to hold the management team, the founders, and the extended management team accountable and actually giving them some guidance. So we put a more formal structure in place. So I joined the board at that particular point in time. I then, from that time on, was obviously a lot more hands-on with it as a non-exec director, but helped them specifically around capital raising as they were working through and actually raising further capital for growth. And then we got Bombora involved in the business, heading towards what was potentially going to be a pre-IPO round investment, to help them with the negotiation of that transaction, and then continue to build the business with that. We then decided to go down the path of a dual track approach of potential further capital raise or a sale of the business, which ultimately resulted in the sale of the business towards the end of last year. We had an external advisor that sort of did a global process with it, but the management team and the board was very hands-on through that entire process, and then negotiating and actually managing through DD, and comforting the founders because they've never done this before, right? Most founders only raise capital, 1 or 2 times. They almost never sold a business previously. They don't know what to expect. So giving them that guidance and support as they're going through that, because it's lonely being a founder, and it's important that they've got people to talk to.
Yeah, so let's talk about that. One of the things that has always been a constraint on venture capital fund managers is their ability to have a diversified enough management team to be able to do a real range of deals. And so,
Yep.
Many funds will focus on one specific sector or vertical, because with the 2% management fee, you have to have a pretty significant fund to be able to have a real significant team of investment directors, of business analysts, et cetera, to do the kind of due diligence and the management of the asset that you need. In this case, notwithstanding the fact that the fund is relatively modest in size, this is a group that has, I want to say, 80 to 90 potential investment directors, all of whom are subject matter experts in their own right, available to the founders post-investment as required. Do you want to talk us through that? I mean, at the last event, that really came through with all of the founders pretty much saying exactly the same thing, which is beyond the investment itself, beyond the cash investment, the network, the Sydney Angels network that was available to them when they had questions about technical and complex things, was one of the things they valued the most. Can you explain that to people who might not be familiar with that?
Yeah, I think that's right. So if you think about like you talked about other VC funds, they've got a range of general partners, so sort of the principals and key partners, and then they've got a number of analysts and more junior team on there. The way to think about Sydney Angels members in some respects is like those general partners, like the principals of the firm, and rather than have, for a small fund, 2 of them or 3 of them, Sydney Angels has got 80 of them. And like an individual investment. And then when an investment gets done by a fund, it's like one partner and maybe one analyst for a larger fund that's sort of attached to that particular investment. Yes, with a bit of support from the rest of the network. For the Sydney Angels investors, it's the entire syndicate is actually there and available. And it's not just the syndicate, it's the syndicate's network, and it's other Sydney Angels members. So when I have a problem in one of the portfolio companies that might be a marketing problem, for example, I've got a person who's an expert in Sydney Angels or marketing who may not be in that syndicate, but is prepared to help. And they are willing to give back and actually provide some encouragement. And the other thing is, everyone talks about sort of 6 degrees of separation. in Australia and Sydney in particular, it's much smaller than that. I think within probably three steps, you can probably get to almost anyone in the country. Obviously, if you've then got a network of 70, 80, 90, 100 people, then you've also got the fund investors. You can get to almost anybody at any particular point in time. So it's exceptionally powerful. It's exceptionally powerful when things aren't going well, and people need help in the hardest times. And it can be really powerful in the positive times to get positive outcomes of things as well.
Let's talk about the first one of those examples, when things aren't going well, right? Because this is a fact of life for a high growth technology company. There will always be significant hurdles. Every single company that has ever made it has gone through potentially, existential threats, right? They always do. They always do. This is not new. It's happened for years. The best companies push through it, but they do need support in those moments. And those moments might be, and those issues that have arisen that create existential threat may be completely outside their technical skill set. My personal view is the support that is provided by the network to the founder at that moment is the most important support you can have, because everybody jumps on board when things are going well, and everybody wants to claim that, for example, they're an investor in Canva, but in the years that led up to Canva actually closing its investment, they struggled and they struggled and they struggled and they struggled to raise the first dollar. It took years and years and years to do that. And that's just one example. It's the people, I think, who are around the founder at that point that potentially are the most valuable. Have you got a view about that? How do you manage crisis inside portfolio companies, and what's useful to reflect on for people who perhaps haven't been through that journey?
Yeah, I think you're right. You're right. It's almost every company goes through an existential situation at some particular point in time. Even the most successful ones look like there's something's going to happen, it's going to fail. The old saying of a problem shared is a problem halved is definitely a component to it. A lot of the problems and things that founders see when things are going wrong is they're deep in the weeds. It's very hard to pull yourself out and actually take an objective view of things. So I think having that support structure around you can actually act as a sounding board and say, you know what, it's not that bad. This is how other companies, and they think sometimes like they're Robinson Crusoe, they're the first person who ever experienced this stuff, and you realize, no, they're not actually. I can go and connect you with other founders and actually talk about how they've actually handled that situation. But you don't necessarily need them to talk to other founders, because you can tell them what actually happened and what the experiences actually were around that. So that's what it's about. It's about sharing it and then solving problems. And so sharing problems early is actually better. I think the strange thing is some founders want to take the view that no, everything's got to be fine. I can't share the bad stuff. Whereas people realize there's bad stuff happening. If you're not sharing it, they just think you're not being completely honest with them around it. So I think it's important, and it's important for investors to know that founders have a safe place to actually share that stuff as well.
Absolutely. I completely agree with that. I mean, I've had experience recently the last 12 months. I won't name the company, but I got a very anxious call from the founders, and it's a growing company and it's doing well in it. But it had some challenges, and the call was existential. And you do need somebody a little removed, one who's been there before, hopefully understands the issue that they're going through at a technical level, so can provide some support there, but also can step back from the day-to-day and say, this is not actually existential. These are the issues of this. These are the components of this issue. Let's work through them. It's as simple as that. I mean, I don't mean to trivialize it, but I kind of, I just wanted to get your view on that, because I think for a lot of people who invest in venture capital, they might see a headline and expect it to be smooth sailing. It's a tough course. It's a very, very rewarding asset class, in my view, not just from the potential of significant oversized returns, but when you see a group of founders who've been living and breathing this problem day and night for years and years and years on end, and have pushed through every hurdle and have had people around them to support them along the way. And then there's an exit like the one we're looking at. you just couldn't be happier for them and for all of their shareholders. Everybody who received the wealth creation result deserved every dollar of it, because it's never, ever easy.
But they absolutely do. And if you look at the EasyClick one, an example, like one of the reasons I do it is, yes, there's good returns. I love the concept of the David versus Goliath battle. So that startup coming in and actually trying to win and actually beat against established people. But I also love the fact that it creates jobs, like lots of jobs creation. It actually helps businesses. Now, any customer of any one of these businesses is ultimately getting more value than they're paying for it, right? So you're creating an economic value. The startups I've backed have created thousands and thousands of jobs, which is absolutely fantastic for Australia, for the ecosystem. EasyClick is an example. We had a situation in the sale transaction where, certain things were actually happening, and I got a call. I was actually at a function. I got a call at 10:30, basically saying, I think the transaction's dead. Like, this thing's happened. We need to work out what we're actually going to do on it. I had to stop drinking, then do a phone call at midnight with them and the buyer, who happened to be in France, and actually assure the company, look, this is sort of normal at this particular point in time in the transaction. This is what they're concerned about. This is how we actually deal with it. It's not that bad. We can actually get through with it. And sometimes it was just a misunderstanding of the buyer and the seller in a particular situation. But you work through those things because you've seen it before and the founders haven't.
Yes, that's right. I wanted to ask you as well about the David and Goliath thing, just a moment on that. You and I are both ex-PwC, largest professional services firm in the world. Often, I'll tell you why that's relevant in a minute. Often, when you watch a pitch of a startup who is in this David and Goliath battle, the first question that gets asked is, yes, but couldn't Google just replicate this tomorrow? Or why do you think Woolworths is not going to do the same thing, with the balance sheet that they have? Goliath, most of the time, is going to struggle to innovate. Internal corporate innovation in Goliath is very, 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 very rare. And when they try it, quite often they burn hundreds and hundreds of millions of dollars with project teams, with expensive consultants for years and years and years, and it ends up with nothing. I think the best and the most nuanced kind of innovation can only be built in a startup outside the confines of the Goliath, because they don't have all of the legacy processes and systems and people and all of the voting and the politics that has to happen. When you've just got three, I'm looking at the EasyClick picture, three guys in a garage with a couple of computers going, you know what, let's take on accounting software. You can just move a lot faster. You can do more. You can fail faster. You can iterate faster. What's your experience with that been like? And how can investors on this call get comfortable that they're going to invest in these tiny little companies that are just going to be eaten up by the Goliaths? How real is that in your experience?
Yeah. I don't think in all the one, and I've done about, so I've lost track, 60 something direct angel investments. I don't think any one of them has failed because a large company has come in and decided they're going to actually do that. Yet, I would say probably a third to half of those pitches, some feedback from people would be, but hang on, can't Google or can't Facebook or can't someone else, insert big name here, do that particular thing? And you're right, they just can't. They can't innovate. I've had examples working with clients over the years where you're working with a large corporate and it takes you a week and a half to organize a meeting to talk about a really, really basic issue, because everybody needs to have their input into it. And there's so much politics involved. You look at EasyClick and there's three founders who have been working together in the trenches for years. They know how each other thinks. They trust each other to make calls on stuff. And most people, in a lot of cases, you might have seen the concept of one-way or two-way doors in terms of making decisions around it. Like, most things are not one-way doors. They're not catastrophic decisions that you can't change your mind, but they treat every decision like it's a one-way door, as opposed to two-way, made a mistake, can come back through and go and then try something different. Startups understand that almost everything is a two-way door, right? Big corporates actually don't. ask covering. There's all kinds of politics and all those kinds of things that get involved in it.
I think I totally agree. And I think one of the biggest challenges inside corporates is innovation often threatens corporate organizational structure, right? Often the business unit leader who is looking at the innovation is also looking at a potential complete restructure of that team, right? Because it's going to make so many things more efficient. And there is an inherent conflict of interest in that. So the idea that that would be innovated internally, it just almost never happens. The David and Goliath thing is a useful dynamic because it allows startups to experiment and to fail and to try and to keep going. And ultimately, Goliath looks at a piece of technology which is iterated over a number of years by a small, smart startup team, backed by a group of angel investors and VC funds, and will make a decision about whether or not they should acquire it as part of its suite. And that's typically what happens. Liquidity is a question as well, Adrian. I want to come to that as well. More and more people looking to place capital in private assets, and one of those, of course, is venture. Venture isn't liquid, but do you want to just talk us through the liquidity process? I know this is all probably a little obvious, but for those on the call who are thinking about how returns are made inside a fund, do you want us to talk us through what liquidity looks like and what the various options are and how capital comes back through?
Yeah, I mean, the vast majority of liquidity comes through the exit of the business. You're unlikely to get scenarios where there are dividends coming out because of positive earnings in the business. Most businesses, if they do get to that, can sort of reinvest that faster and actually get a better return and therefore deliver the capital return. 9 times out of 10, it will be a trade sale of that business rather than IPO, although an IPO is a potential. There's been a couple of scenarios where we've had some sort of IPOs. In fact, one of the best returns that the Sydney Angels portfolio had out of the broad portfolio was Clarity Pharmaceuticals. At the IPO time, that was a 50 times return for those first round investors. At its absolute peak, I think it was sitting on something like 140 or 150 times return from those from that original investment. So you do get those extreme cases. But yeah, you'll generally find the bulk of them. The fastest returns will happen sort of 4 to 5 years is the general kind of time frame. But I find the general better long ones are taking 7 and 8 and 9 years time with the deep capital markets. There is a thing that's starting to change in the Aussie market, which is the secondaries and secondary funds. So we haven't historically had that. It's very, very new. But there's a number of secondary funds in the market at the moment. So I think you'll start seeing increased ability for secondary transactions, which is like a partial sale when you're doing another transaction down the track. You're also seeing a lot more big US and US in particular VC funds come into market. When they're coming in at later stages, they often want to invest more money than the company wants to raise. And that obviously increases the chance for liquidity on secondary sale transactions.
And look, before we move to the portfolio companies, I think we should spend a moment on that. I'd love to hear your view on those companies that are in the portfolio now. I just want to stay on that point that you were just on, and in particular, value accretion and how and when in a startup it typically happens. This idea that I'll just wait until it's been proven, right, is, in my view, completely counterintuitive to the desire to obtain venture-style returns. Once it's proven, the opportunity for uplift is significantly lower, isn't it? Can you just talk us through how you think about value growth and in particular, where does Sydney Angels play in the stages of a company and why?
Yeah. So let me start by the final part of the question. So Sydney Angels generally plays in the earliest stages of investment. So it's really that pre-seed and seed investments round. It's quite often investing in that round. It's the very first external capital round that a company is taking on beyond that family and friends round. The round sizes are usually, I'll call them in the 400 to a mil, 400 to 800, sort of average investment around sort of $600,000-$700,000. Sydney Angels is not the sole investor in that. It's normally a range of other investors. When we do transactions, when we do due diligence and stuff, we actually then introduce other people to it. People understand the robustness of the Sydney Angels DD process. That's actually seen as a positive by other investors. And so in those very, very earliest stages, you're also not competing with the big funds. There are lots of big funds who say they play really early. They don't. They don't really. A couple of them will, but it's quite small and very, very unusual for them to do so. And when I'm looking at an investment, every single one at the very early stages, I'm asking myself the question is, do I think this company has the potential to make 10, 20 times return on capital on it? I'm not looking for doubling in 3 years, 5 years, that kind of stuff. I want 10 or 20 times in that kind of time frame. In fact, the right raise at that earliest stage is like, how much money does the company need at that particular point in time to deliver a genuine value inflection point at that next round, sometime in the next 12 to 18 months? And at the stage we're investing in a perfect scenario, that next round is done at double the valuation of the current round. That's
Yes.
the kind of that's the kind of target
Yeah.
we've got. And in fact, I'll use an example. So, Mary Technology, which is one of the portfolio companies now, to a slightly later stage portfolio company in the sidecar fund because it's gone through that process already. Its very first round was done, and the second round was done at double the valuation, and the third round was done at not double the valuation, but slightly less than that, which is when the funds come in. But you sit there and look at the growth around it and say, can this thing still do 10 or 20 times? And the answer is absolutely on the trajectory they're actually on. Like, it's one of the fastest and best companies I've seen for a long time doing enterprise sales. And Mary's also the classic example of VC saying, oh, but can't Harvey do this? Can't Legora do this? Who are the big global gorillas in this space? And the actual answer is no, they can't. And in fact, the week after a VC's response for why they weren't going to do the transaction is Harvey told some of Mary's clients, sorry, we know about Mary and we can't actually do it and we can't compete. They're actually better at it than us, and we'll partner with them or acquire them down the track rather than try to compete with them.
Yeah, great story. Do you want to spend any more time on Mary? I mean, obviously, it's what I want to move to the portfolio so people get a sense for, yes, they're investing in a strategy and people and the processes that we've just discussed, but they're also right now investing in 6 existing portfolio companies, and Mary is one of them. I'll just let you take that where you want to go, but.
Let me talk a little bit about Mary in terms of and why Mary and what it actually looks like and what the syndicate worked through as part of it. So the syndicate saw in Mary 4 co-founders in that business who all were complementary in what they brought to it from different components of it. You had the tech person, you had the lawyer, you had the salesperson, and you had I call it a generalist CEO with tech as well, all working together. There was a real genuine problem that they were solving. I think when we first talked about it, you was like, former lawyer, like, I know this problem, like it exists everywhere. They had the demo of the product out. We spoke to a couple of customers. The customers absolutely loved it and raved about it, saying that, I think the lowest estimate for time saving was like 75% time saving on these particular tasks. And it was more like 85 to 90% was the general feedback. You sat down and looked at it and you realized it was an extraordinarily large market. There was a school of thought from some people that AI was going to actually reduce the demand for lawyers, whereas I think people don't fully appreciate the actual real economics of the legal market, and that there's actually a lot more opportunity for more cases to be done, which are currently not being satisfied. So there's this actual social component of social justice that comes through from it as well, from actually letting people actually get the advice they need. And it ticked all those boxes, and they were executing, and every single thing they said they did, they did. And they took feedback and advice. Like, they were almost like the perfect scenario what you do it, and they've gone on and proven with their execution of it that it's and it's still going gangbusters. I mean, to be honest, anyone coming into the sidecar fund now is getting into a business at the same price, and since we did the investment, the business has grown by 50% in the last 4 months. So I don't know. We're probably being too kind to investors in that regard, and iiShield's the same, right? when we did the first investment, I mean, for those people who don't, iiShield, they're doing what's called a kidney pajama. So when you do a kidney transplant, the kidney when it gets transported from one hospital to another one, it sits in a little like cooler box, and it's all great. But the minute they start the surgery, the kidney starts warming up because it's got no blood supply, and after about 20 minutes, it's at a suboptimal temperature. And an average surgery takes 40 minutes. So a surgeon rushes, and when a surgeon rushes, they actually make mistakes. So you get this scenario where the whole way the system operates doesn't give pure optimal outcomes. They came up with a crazy idea, which is, well, how about we make a little pajama pack that sits around the kidney and keeps it at the right temperature whilst it's being did it, and it got them, and they're doing that trial. They're now in clinical trials. When Sydney Angels Fund first invested, they had the idea of the trial. They hadn't proven up parts of the technology. That's now been proven. They've now done 9 transplants, complete success rate, going fantastically, well on the way. They've got now agreements from hospitals in the US to start actually doing it. Again, same valuation around it. I love them. I love the iiShield one. It's a huge, profitable product. It's a massive market, and the added bonus is it saves lives. Like genuine, genuine. It's a life.
It's always nice. Yeah, always nice.
There's some fantastic ones. Actually, do you want to talk about the newest one that's actually not been announced yet?
Go for it.
Anaxium. Everyone's familiar with AI and data centers, right? And everyone is familiar that the biggest issues with AI and data centers is 2 things: energy consumption and water usage. Anaxium is technology that they describe as a water positive cooling system for data centers. So it reduces the energy consumption in cooling data centers, and rather than consume water as part of that cooling process, actually produces clean water. So you can use basically dirty water, which you historically can't use, and create clean water out of it. It's a technology that was originally developed for the mining industry that has been turned into, by the original inventor, now into this usage in that. And they've done their first proof of concept at small scale, and actually come through with flying colors on it. So yeah, we've got this massive investment happening into data centers globally. And we've got this technology in the fund now that is solving 2 of the biggest problems that comes with data centers, and 2 of the biggest resistant areas where people are fighting against data centers. So it's like a 10% reduction in energy consumption on cooling a data center, and turns consumption of water into production of water. I mean,
very impressive.
What's not to love?
Very impressive stuff. Hey, I want to make sure we've got enough time for questions. If it's okay, let's move on. I thought I might just quickly go, Jace, we might just go to the fund structure guide slide. I'll just talk through this very quickly, and then we'll turn to your questions. If you do have questions, folks, just have a look at the Q&A panel at the bottom of your screen. Just pop them in there, and we'll get to it very, very, very shortly. So this fund is structured as an early stage venture capital limited partnership. If you don't know what that is, the ESVCLP program is a federal government program that's designed to incentivize investors to invest in early stage technology companies of the kind that Adrian has been describing, and of the kind that is in the target investment strategy for this fund. And the way government does that is to provide a suite of very, very generous tax concessions. In fact, other than your sole and principal residence, this is the only way, investing through an ESVCLP, that investors can secure tax-free returns, completely exempt of income and capital gains tax. And in addition to that, all investments that are made into the fund, investors receive a 10% tax offset that they can claim in that financial year. So the tax concessions are very, very generous. The minimum commitment is $25,000. This will be called in 5 equal annual installments. What that means is you can participate in this fund for just $5,000 now, another 5 in 12 months' time, and so on and so on and so on. That low entry price is very, very intentional. This fund is intentionally designed to democratize participation by removing the barriers. We know that there are lots and lots and lots of people who want to do the kinds of things that Adrian was talking about. Everybody, this is an investment play, so everybody wants to achieve a return. They want to do it in a diversified way. They want to do it in the hands of good managers and people who understand what they're doing. And they also want to contribute, generally speaking, when I speak to investors, to the innovation that's going to make a difference to the community in which we live, to create jobs, to fix major problems, to save lives in some cases. And we don't want the barrier to entry to be so high that it excludes lots of people. So 25,000 is the minimum commitment, called over 5 years in equal installments, which means you're in for $5,000 just today. Once we reach $10 million in this fund, the fund manager will charge a 10% premium on all new investments in the fund. For all the reasons Adrian just described about the existing portfolio, that's only fair to do that because that 10% premium will then be paid to the existing investors to reflect the time value of their money and the risk that they've taken by investing early. But until we get to 10 mil, and we're not there yet, that 10% premium is waived. So for anybody who participates today, up until we reach 10 million, you won't need to pay that 10%. I'm going to skip the investor portal stuff, Jace, just given time, and we might just go straight to the poll. So Jason's going to bring up in a moment a poll where you can let us know if you'd like to secure an allocation in the fund or you'd like more information privately. We can get someone to give you a call. We can talk you through whatever questions might be on your mind that you're not necessarily prepared to discuss here. If you are interested in participating, I highly recommend you do that using this poll, because we will be prioritizing allocations tomorrow on a first come, first served basis, starting with the people who've indicated their interest by using this poll now. So just take a moment to do that. And then I think we'll go to more questions, Jace.
Perfect. Thank you, guys. That was very informative. We do have some questions coming through. So as Steve mentioned, just pop any in the Q&A spot at the bottom there. Here we have one of our audience members. I know previous performance doesn't guarantee future returns, given us the disclaimer there. Can you give an overview on previous sidecar funds performance?
Yeah. Let me take this one because there's something quite specific in this too. So the fund manager for this fund is actually different from the previous ones. And so we definitely can't refer to that past performance, but I can personally talk about the fund returns as an investor. So the first sidecar fund, which was actually I think it was the third ESVCLP ever registered in the country. So lots of learnings that went through that process. It has literally finalized all of its portfolio apart from a couple which have gone into a continuation vehicle for liquidity. But in effect, that fund has returned 2 times, so post all fees has returned 2 times the original investment capital that was actually put in. And the IRR is about 11% on that. The 2 times is pretty good in the market, especially for the where the fund actually was. The 11% could have been stronger. It got impacted by combination of some financial stuff generally in markets, but also from COVID. So there was one particular company in the COVID market that was going to exit just as it was going into COVID, and that transaction fell over and then proceeded to get done 5 years later at exactly the same price that it was being done at pre-COVID, and as a result of that, it actually had quite a significant impact on the IRRs of that transaction. The second fund, that's actually almost impossible to tell at that particular point because it's only monetized a small percentage of the portfolio because it's coming towards the monetization stage at the moment. But at the exact same point in time, as the first fund and the second fund was, the first fund had returned about 10% of the capital that had been invested. The third fund has actually returned just over 30% of the original capital invested. So it's actually a couple of faster initial returns. And I think you'll see the second. I think the second fund will do better than the first fund. It's got a couple of really good standout portfolio companies in there that are working through. I will be, obviously I would say this. I think the third fund is probably going to do better again. I think it's a different market. I think it's actually a more favorable market for investments overall. But again, yeah, it's impossible to tell at this particular point in time. Sorry, and those returns to obviously tax-free returns on that, given the ESVCLP structure. So that sort of enhances it again.
Yeah, thanks, Adrian. We have another person on here. If you assume only 20% of portfolio will deliver a meaningful return, what multiple is the fund targeting? They obviously saw the 20% IRR on docs, but what does that mean in terms of multiples on my money?
Yeah, so I think genuinely getting sort of 2 to 3 times net of fees is a good. I mean, you got to remember, I think the stat is almost the vast majority of funds, especially the small scale funds, don't return original capital. Something like 60% of early funds don't return original capital at all. So getting 2 times is top quartile performance. But I think sort of 2 to 3 times is a realistic target.
Excellent. Thanks, Adrian. We have George has asked, Adrian, what do you think? Who do you think would be a realistic buyer for an Axiom in the future?
Very hard to speculate. There's a huge number of buyers. There are lots of people who provide services to data center markets, so people who do fit outs, electrical providers. There's a huge number of people who do air conditioning and cooling units in different systems. Multiple multi-billion-dollar businesses. In fact, some of them, I think we were looking at it, some of them are worth sort of $30-40 billion in global markets. It's got global application. It could be left of field. It could be an actual data center operator who wants to actually keep the proprietary technology for themselves to get a competitive advantage over others. I think there's lots of parties.
Yeah, thanks, Adrian. Adam has asked about how close are we to the 10 million target? We're over halfway now, aren't we? So
I think we're getting close to $6 million now at the moment, and I think the pipelines for expressions of interest is actually quite strong. In there as well. And we've also got we were talking about this other day, I think we've got a batch of people who are sort of saying, as you start getting closer, tell us. And then they sort of come in, everyone wants to sort of get towards the end. And I think there'll be a big rush at the end.
Yeah, agreed. Adam also asked about if the investor signs up for 50K at 10K for the first year, can this be increased or decreased for subsequent years?
It can't be decreased, but you're very welcome to top up your investment over time up until the final close of the fund.
Yeah, and I think the final close is technically 2 years from registration, so it's not a long time, I think, from memory. We've already had a number of people who've actually increased their investments from the very first round to coming in with more as well. So
yeah. And our expectation is that will continue over the next few weeks, especially with the strength of some of the portfolio companies and how they're going. Some of those updates have been very, very well received by investors, so we're expecting that to go up in the next couple of months as well.
Yeah.
Another question has just come through. How many portfolio companies in the fund now? There's 6.
There's currently 6 in the company. So the others, so we talked about iiShield, Mary Technology, and Axiom. There's another one called Crosscourt AI, which is, as you'd be surprised, an AI functionality which actually serves people in the private credit and investment banking market. So it actually takes a lot of the analyst data for creating initial investment papers and reporting, and actually automates large components of that. And they've built in a full verification and audit trail process that actually does that. It's actually insanely impressive for the version they've just released on that one. Then the other one was a company called Profitate, which is an AI marketing and outreach tool that helps people who are trying to acquire and do sales actually target the right prospects at the right time based on their online activities. We really actually love this one because it's got a really good AI flavor, but it actually is genuine sales. And the founder actually used the product to effectively bootstrap with a small amount of capital his original business to a break-even point, and actually built the tech around it. So he proved it by dog fooding his own product and actually getting out and growing the business, which is fantastic. And then the other one is a company called Flowganise, which is a relatively new investment as well. And they analyze basic conversion performance of websites, and then they target businesses who lack their own teams to do this. So there are people out there who charge $5K to $20K a month to do this kind of analysis. That's not valid for the 7 million businesses that are sitting on Shopify or WooCommerce and those other kind of platforms. So this is a much lower entry price point model that uses AI to actually do that and continuously monitor and then give direct feedback around it. And it's getting some fantastic feedback from initial users as well. So they're the 6 in the existing portfolio.
Looks like we've exhausted our Q&A by the look of things.
So if people got other questions, I'm happy for people to reach out to me on LinkedIn as well. I'm more than happy to have a conversation. You can probably tell I love talking about startups and angel investing.
We can vouch for that. Definitely do. Thank you. I guess as our questions have ceased, I thank everybody for joining us today, and thanks Steve and Adrian for your input and for preparing that. That was very informative. And thank you to those that have filled out the poll. It looks like quite a few people have filled that out as well. So we'll be in touch in due course, and we will send the recording out in the next day or so, most likely tomorrow. So thank you, everybody. I'll end the webinar there.
Excellent. Thanks, everybody.
Thank you. See you.
Good day.